Hello, Warriors. Hope everyone had a great weekend. And let's all visualize a constructive week. You guys with me? Can you see it? How you doing, Ingmar? Mike? AJ? Hi, James. Bran? Yes, the rocky shores of England. Glenn? Kman's with us today. Bran? Oh, good guess. Blake? Paul, how are you? Okay, so something that last week discouraged me from, the short side of the dollar was this euro pound. Okay. This was a move that we were making after the breakdown, euro weakness after the elections, and we have some pretty nice divergence off of drive two. Okay, so things could be shifting here, at least temporarily. Maybe, we get back to the breakdown at 85. The cable, I'm looking for another maybe 40 to the downside. But we've either turned here, or the other two options are we could pull back to 84.20 or possibly a third drive. But it's a lot different. I mean, you could see it on the screen today. Euro's still up 6. And Euro, by the way, let me just get rid of it. At the lows last week, we're 78.6 back. Okay. 106.67 inside day. I'm not saying that we can't play with this area, even take out the lows, but I'm leaning towards buying it and being wrong under 106. I do see the possibility of 105, but I'm going to give a short side of the dollar one more shot this week here. And, this could be the area in here. So EG, I think, is a different change. Now, back here before we did this, I thought 620. That looks like that could be done. And, Aussie's still the strength. Maybe it's only 550 on a pullback, another 40 or so. So that's the way I see the currencies this morning. Yen's pushing again. Looks like it may want to challenge Friday's high. Want to start off. Good morning, Blake. Good morning, Kman.
Good morning, Dale. Good
I
morning,
know
Blake.
Ryan's on vacation. Hey guys. So your take on U.S. dollar yen, BOJ out of the way. We had that little reversal day that's showing no follow through today.
Yeah, absolutely. A lot has to do this morning, at least, with what's happening on the euro side of things. We've seen a bit of a comeback of the euro, especially underpinning all the euro crosses, because the spread between the French and the German bonds are narrowing a bit. ECB tried to calm down the game a bit. And the euro is picking up a little. At the same time, we see smalls higher yields elsewhere, and that's putting a bit under the dollar yen again. There's still enough uncertainty, I think, around what they want to do with the bond buying reduction. One ex-BOJer said that they may reduce by as much as 2 trillion yen per month, which is a decent amount, because that brings the bond buying well below the redemptions that we get, but they still need to start to do their meetings with the market participants, so we don't know yet. At the same time, Kishida came out saying that they are still cooperating closely between the Bank of Japan and the government. They are also not overly happy with how consumption is going, and that's putting a bit of an offer in the yen in particular, but also the Swiss is a bit better offered. So it's the low yielders are suffering, or let's say giving back some. So I think for the yen, it's going to be a waiting game again until we know more. And at the same time, in the meantime, it's still a bit hard to stay long yen for longer. I'd say I'm still not changing my view on that one, but I'd say we are more in ranges than outright more yen weakness, perhaps. So we are in a wait and see pattern for now.
Okay, so down here I was worried about, even though we broke a trend line, about one more shot up to 105.50. It traded 40, then it traded 45, and then got through 50. But the dollar as a whole, I still think now it's a better risk reward scenario here, and you're wrong over these highs.
Hmm.
So I think it's an important week for the dollar to either this be a failing rally or the dollar bears are all wet, okay, including me. So we'll see. Metals giving some back. I was looking at 28 and a half, and we almost got there, 28.60. Uh, I tell you what, you really need a strong constitution to trade gold. You know, down 25, up 25, down 13.
Yeah.
It almost looks like, consolidation off this. I guess this was a China day, and getting back under, say, 2,300 is going to open the door for, at least two and a half, maybe lower. So, what kind of convinced me is we were up 25 Friday, but and the gold shares have not been lagging; they've been kind of leading. But even with gold up 25, you really didn't get much going in, you know, Newmont or GDX was just up. Actually, it was a red candle with gold up 25. So, a lot of these. Even silver ETFs are under moving averages. I think that FOMO, you could wait and not have FOMO. This is really corrected pretty classically. I mean, if we had Grega here, he'd probably, even though he said buy gold last week, he'd probably call this a nice, normal correction, uh, ABC maybe, and First Majestic. So it's getting close, but I don't feel like I have to be in a hurry to buy that. Um, why don't I go to Blake on risk for this week? Blake, there it is.
Oh, we
S&Ps.
need to be selling with both hands this week, Dale.
Well, we do have the end of spring, the beginning of summer, and also, one of the big, huge option expiration weeks of the year. There's four of them, and this is one of them. And when you have that kind of volume, it does give people a chance to do whatever they want to do without moving markets, because there's lots of volume into option expiration week. So we'll see. I don't think we're ready yet. What would be your first danger sign in S&Ps on a level, Blake? Where would it be 53 and a half or something like that, prior high, for us to know that something's going on that's negative?
Well, for me, it is, yeah, you got to start making like lower
Lower
lows,
lows.
and really I mean, 5,300 is really the big breakout point. You can see it that far,
Yeah,
not far left, but the high right there. Yep. So,
yeah,
we have to get below that, and you can also see your green moving average is the 50 DMA. So those
yeah,
are between that and the 50 DMA and that 5,300 level.
yeah,
Um, I don't see why anybody should be bearish risk at this moment. Now, there's obviously risks at this point, because you look at Bitcoin, it's trading below
yeah,
66,000. It's starting to look kind of weak. But
yeah,
I mean, the dollar mex looks fairly well bid, but that, is for other reasons, but nothing. And then copper looks weak. By the way, copper looks like it
yeah.
wants to break down, and
So,
it's actually probing really key support right now as we
wow.
speak,
I
as it's
mean,
at
the whole
lows.
world really turns, super uber bullish up there.
Oh
I don't
yeah.
think many people were, looking for this. I mean, copper was more, sentiment wise, I believe was more bullish. People were more bullish copper than the precious metals.
Yeah, I think everybody believed at some point that electric vehicles were going to take over the earth like this year or something. So, and I think that's why it was rallying, but it is amazing. It's come back. This is actually previous breakout point.
Yeah,
So, so I see the reasons why stocks should come down. And then there's, there's not buybacks are being prohibited right now for a lot of companies, and there's all these reasons, but the stocks haven't. I'd rather say prove it, and
yeah,
have the stock market actually show some weakness versus trying to anticipate it. Because if you try to anticipate some weakness and you try shorting up here, you're probably going to be back up in your face again. At some point, it's going to work, but I haven't
yeah.
seen it.
Well,
Prove it to me.
I've been waiting for Amazon, and I was at my in-laws, and Amazon, they just brought it up that on returns now, used to be able to go to not the post office, but UPS, just for your exchanges. And now now people have to bring it to Kohl's or Staples, which isn't as convenient, and probably because the other way was costing Amazon money. But it's inconvenient. I think it's going to also, people go, well, if it's such a hassle to return things and I ordered the wrong size, maybe I should go somewhere else where the returns are easier. So just, anecdotal evidence of just John Q. Public and their feeling about Amazon. So I've been waiting for, third drive. So I'm trying to be patient to see it take out this high, but this is a shorting candidate for me. Um, Also, the banks are not uh, are not participating, and that's with lower yields. And the scariest thing about the bond rally is that it hasn't helped the regional banks at all. And most of their problems were their bond portfolio. So with the rally we've had in bonds, what's wrong with this? I mean, we're a major support, and we break down the measures pretty deep, and really it never did anything real right. So I still think we have a banking problem. All it did was, like, you know corrective rally back to old resistance, and now rolling over again. So there could be, um I know no one's worried about it since SVB, but that is kind of an ugly weekly, don't you think?
It is. I mean, banks look horrible, but again, it's one of those. They do, but are they? Is that going to be what drags down the market from here? Um, I mean, there's all these reasons why it makes sense to be selling risk up here, but you just have to say,
Yeah.
okay, well, what's going to trigger it? Will it be the KRE? I do think these regional banks look like
Well,
crap. I've got people texting
yeah.
me all the time about
About
commercial real estate, and
All right. Yeah. Well, I'm sure things are okay because Powell said they're all strong and have built up reserves, but people that are voting with their wallet disagree with Chairman Powell. And anyway, I used to put up Johnny Lang's song, Lie to Me, Tell Me Everything's All Right. And that's what he's up to. But we have a great guest today, Blake, to talk about the Fed. Jamie's here from Reuters, so that's going to be something I think we should address, because the only market that didn't feel his pushback were the bonds, and they're under some pressure today. So, like Kman said, there's some give back in yields. And I think it's going to be pretty important for TLT to hold this 93 level. Um, Otherwise, what we have is a false breakout in short term. It could pull back. I mean, it's been one heck of a run, but the bond market, maybe they do believe Powell, and it's higher for longer, and that's why bonds rallied, because they're worried about, could it be economic weakness?
Yeah.
One of the first weeks I saw bonds outperform stocks. Okay, that hasn't happened in a long time. So we'll see. I wouldn't be chasing TLT up here though.
I wouldn't, but there's a big move in Boons, recently, and TLT, well, global
Yeah,
bonds have really rallied quite a bit. We got a few central banks this week. I'm going to
that
take
too.
over, Dale,
Go
and
ahead.
let's discuss some of the central banks that they're meeting. And good morning, Kman. How you doing?
Hey, yeah, I'm all right, man. Thank you.
All right, and Belgium plays today in the Euro
They will, yeah, they
24.
will.
Yeah, it's going to be everybody. You
In
got
about
everybody
4
in the
hours
Forex
time.
Analytics room that is cheering your team on. But let's discuss the RBA. The RBA is going to be up first, and it seems like that they're just going to keep rates unchanged. The Aussie is, I think, a little vulnerable here. You look at the way the price action from the last week, we kind of failed up here. We're back almost at the 38% retracement. You can see this is also the 50 DMA. How do you feel about the RBA today?
Um, Firm hold, and then it'll depend on what Bullock says in the statement, because remember last one, they were even talking about a potential hike. I don't know that the data are strong enough to bring it back on the table, but that will be, I guess, what the people will be looking at in the statement. It should be a hold. I don't see personally a reason to hike from here. But yeah, the statement will probably do the best of the heavy lifting. If they take the hike off the table and just transform it into a higher for longer, it may hurt the Aussie perhaps a little bit.
Yeah.
But that's about it. What I see in this meeting, it's going to move because of the time of the day. But whether I see whether I see something spectacular right now to do in Aussie, not at all. Absolutely not. I don't have a view, to be honest, on the Aussie right here and now. Globally, I also find it a little underwhelming. So I guess that any weakness could see a bigger impact than keeping what they had on the table before.
Okay. All right. That makes sense. You know what really got my attention overnight? I've just read a couple of things this morning, getting up that and a lot of people are expecting the Swiss National Bank, they might actually cut.
Mhm.
And is that on the heels of, and in the ForexAnalytix chat room, I'll just show you guys in the news and research room, you reported this, the Swiss
Mm.
economic projections. They were slated to come out, but it looks like growth forecasts they tick down a little bit. Is that the reason why you've seen a chorus of analysts think that the Swiss National Bank may cut? I know they only meet a couple of times, 4 times a year.
Yeah, they only meet once a quarter, so they don't have as many opportunities to change their monetary policy as other central banks may have. I think that's a limit border case. I'm really, if we only would bank on inflation and inflation outlook, we are not too far from where they are, because we've seen an initial drop in inflation, then a little bit more sticky. Now they're expecting it to be lukewarm. I, I'm, there may not be enough in data for them to cut back to back, but we have seen the Swiss strengthen quite a bit since the troubles in the rest of Europe on the political front. We have seen also we had a bit of a risk of flow that also put a bit under the Swiss franc. Would it be to please the Swiss corporates just to tell them, yeah, we are still taking care of you? That is a possibility. So I think we are really, mm, if they cut, it's going to be, in my opinion, one and done, because they will be at 1.25%, which is actually at or even below the last CPI print. But then it's all going to come down to growth. As the government said, the growth is underwhelming, so they may get tempted to cut. But really, that's a near 50-50 to me. But if they cut, yeah, then I think the market will pick up on it again and start to sell Swiss franc again. That's what I expect.
It's interesting because they have to, and this is one of the things that I talked about on the week ahead video, is they have to be a little careful here, because if they are not, if they're not real dovish, they've had a rush of investors really flood into the Swiss franc just over the last week, because obviously this is the French German yield blowout that we saw from last week. You're having that rush to safety into the Swiss franc, and they have to be careful not to undo everything that they've done,
Yeah,
for the last year or 6 months.
Yeah, actually, it's quite funny because the market hasn't done it. That's a good one over there, the Euro Swiss, because the market has we've had two. Uh, uh, let's not call it shocks, but we had two events there. You had the Mexican elections, which has pushed people out of carry trades, and there must have been some in Swiss mex as well as mex yen and Euro mex and things. And then we had the European issue. And so now it's up to the SMB to say, like, are we going to respond to that? Do we really want our Swiss franc to weaken to please our corporates, or asking the question from the other side, is a stronger Swiss franc going to hit my corporates? If they judge that that is the case, they may actually cut indeed.
Yeah, it's
And that would be telling the market, don't buy my currency.
Yeah, right, exactly. That would be interesting, and that's going to be a fairly big mover, in my opinion, on Thursday morning. It'll be in the middle of the night, unfortunately for Dale and I, but also one of the things on Thursday we will cover is we're going to cover the Bank of England. And what are your thoughts there? And I'm just going to show you guys technically one of the big risks is, and Dale, you pulled up the euro sterling earlier, but the pound had the false breakout, reverse. We broke below channel support. We're trading heavy right now. It looks weak.
Yeah,
and
exactly.
Yeah,
Exactly what I said on the flow show as well. I think we've had this relative outperformance of the sterling for a long while versus the euro versus other peers in the market, like the Swiss D and you name it. But this week looks like a dangerous week to me, because we not only have the Bank of England, we also have the inflation report just the day before, and we are 2 and a bit weeks away from those elections. So this could be a bit of a week where we have to be very careful on the sterling, and I've really put my my relatively resilient sterling view in the fridge for now.
Yeah, because it sure did feel. I mean, I was like, man, this thing's gonna do the unthinkable. We're gonna be trading above 131, in the coming weeks. And then obviously last week's reversal, it, put that idea on ice, as you're saying too. And it sounds like you feel the same way. Yeah, and that goes back to looking at the dollar and the dollar index. This is one of the things that I just want to make sure that everybody can see here, is that we are in a big triangle pattern. You can see it in this red dotted, these lines. This is we're in the middle, or in the the middle of the apex of the triangle. It's very whippy. We don't have a lot of direction. You have to be really careful when you start getting to the fringes of these triangles. Dollar looks like we could continue to rally, which would put the euro, lower. Obviously, there's a lot of Eurozone concerns, but, you look at sterling. If sterling comes under pressure, it's just going to add the fuel to the fire there. But I think we have to be careful, Dale, when we get towards 106. Do you think the dollar has the juice to break out, Dale?
My stops are above there, but I'm selling rips all week to see if it happens. I think that the turn in euro pound is important, because the leadership in the Dixie is euro. So
yeah, it has been.
Yeah. So if euro's low, as bad as it looked, and the week is an ugly weekly candle, but Friday's low was 78.6 back of the rally. So, you know, I'd be long euro on dips against 106 for a stop to manage it, because, you know, we take that out, we're going to 105 or so. But I'm
Okay.
going to give it another week or so to see if we could fail, because this could be, that triangle's huge that you were showing, Blake. I think it's like 14 handles from 99, no, 99 to 107. So it's 7 handles on that triangle. So if we break down, that would be pretty big too. That would take it, you know, under par. So that's what I
Yeah,
still think we, yeah.
I I don't know, you know, and I don't. I'm really. I have. Well, I'm a little skeptical buying the euro at this point. Until we get past the like the French elections, which I believe somebody can correct me if I'm wrong. I think it's the 30th of this month. June 30th is the
Yeah,
French
the first
election.
round.
Yeah, the first
The
round
first
of the.
round, and then the second round on the 7th of July.
Okay, yeah. So I need to see. I think we need to get past that before the euro stages any type of recovery. You know, obviously, that could also mean that the euro drops below, 106, and if the euro drops below 106, that's that you can see the triangle is very apparent here. You break below 106, we're trading down at 105. We break below 105, and the euro's trading back at
So
parity. So.
would you short it here?
It's great that you asked. We put in a pattern in play about an hour ago because the
Okay.
euro dollar is at previous support,
Yeah.
which is, you can see it right here, which is current resistance. And that was about 5 pips ago, less than an hour ago. So while it trades below the 107.20 level, the
Yeah,
risk
I
is
see it.
lower now. Yeah,
Okay.
the risk is that we trade back. We'd had a nice enough of a recovery since Friday, worked off a lot of oversold technicals, that if it's going to resume to the downside, it should be around these levels. And so that's yeah. So to answer your question, yes, and we've already
Okay.
identified
You're
it
there.
about an hour
Okay.
ago. So
Thanks.
yeah.
Nice. The other thing I just want to bring up is that people probably feel the same way as you, that it's a no touch because of the elections. And we could have a rally into the elections and then it come off on what happens in the election.
On
Because no
on,
one
on which currency there?
on the euro
On the
could
euro
rally.
into the
Could,
rally into the elections. I don't know. It has to be said that Le Pen did water down her stance a little bit towards leaving the euro, or wanting to explode everything euro, but she's keeping a pretty harsh stand on all the rest. Whether, if I may, I want to come back to what Dale said about and you guys talked about the banking index. Dale, I think it's a matter of who is watching what right now. It's like the flavor of the day, and this thing is going to come back to bite if we see a bit of a slowdown coming in the U.S. economy. If we, for instance, seeing a bit of a slowdown in the jobs market, starting to confirm what we see on the non-NFP reports, I think then this stuff can come back to bite, like the accelerator of things, you know. But for now, I think some market participants or
they don't care.
the
It's
big,
not
well, it's
Nvidia.
not that they don't care, Dale, it's that their model, or they say like this is not what is primarily on the top of our agenda right now. So it's all about fashion, you know,
Yeah,
and
Nvidia.
sorry.
Nvidia.
Yeah, something like that. If
Oh,
you concentrate on Nvidia or on Tesla, you don't concentrate on the local banks. That's and I think that's a lot what's going on in the markets right now in general. Because look, we have been trading euro for a couple of days, and I think from tomorrow we are going to trade the dollar again with the retail sales.
okay.
You
Mm.
All right,
know,
everybody. That's
and
what's
retail.
beautiful about what we do is, it's not, everyone has their own view to express, so that you guys out there have differing views, instead of going into rooms where, they have a policy. Look, it's my show. I'm bullish gold. Don't give me the bearish argument in front of our subscribers. So go ahead, Blake.
Oh no, no. Well, to reiterate what you're saying, yeah, that's all our chat room is we're debating on what's going
Yeah.
up, what's going down, and why things are going moving higher and lower. You're absolutely right. So, but I did want to point out, NVIDIA is at the 261% extension of this last consolidation. Nick pointed it out on the week ahead video, Nick Groves. Just keep an eye on that. And Kman, I have to agree with you as far as the it's what is in the market's purview right now,
Well, we
what's
spoke about
moving.
that on Friday, right?
Yeah,
It's a
yeah,
thing
it's
of
all about concentration. I mean,
yeah,
let's
and it
face it,
comes and goes.
if you're a portfolio manager and you have to keep up, everybody's unfortunately playing hot potato right now, and but everybody's chasing the same thing because they have to. Because if you don't and you don't perform, you're out of a job. So I mean that's plain and simple. So
Yeah, and
um
that's it. And if you go short markets because the KRE is on the verge off, and the rest of the markets go up, you look like a dumbass, right?
Yeah,
yeah,
well,
that's
just
it.
short KRE and
Yeah,
XLF.
exactly. Yeah, absolutely. Thank
You
you,
don't have to
Dale.
short. All right, man. All right, Blake.
Thanks, Dale.
Yeah, all right, everyone. So, what a great time to have Jamie here after a Fed meeting last week. Reuters Jamie McGeever, welcome back to Face. How are you doing, buddy? There you are.
Can't hear him. Can't hear you, Jamie.
The most basic part of
Now,
the show,
we,
and managed to fail at the first hurdle. Morning.
all right. Hey, Jamie, how are you?
Good, thanks. How are you?
All right. So, instead of me leading the first question, what is on your mind, biggest issue that you see out there? Maybe your reaction to Powell pushing back on a good CPI number last week.
Well, it was interesting, wasn't it? He was asked at the press conference if the CPI data had, changed any of their minds, because they saw that, if I'm right in saying, they saw the numbers that morning. Is that right? But they didn't. But I don't think any of them officially changed their, their dot plots. However, I think it's quite clear that if we continue to get numbers like that, softish data, disinflation gathering steam, then those dot plots will change, and that will kind of render the revision upwards that we saw last week kind of redundant.
Yeah.
It's a kind of a whipsaw move in thinking, mentality, and probably market pricing. But I mean, here we are. Every time I'm on, we always talk about the market fighting the Fed. It's been a losing sort of fight over the last couple of years, but they continue to fight the Fed in a way, because what I'm seeing now is two cuts priced in for the year, and the dot plots are only suggesting one. However, as we just said there, perhaps those dot plots will have to be revised back down again in 3 months.
Yeah, so that begs a question, Jamie, because even after the Fed pushed back, yields dropped to a new low, and it's a possibility if rates keep coming down, and I still think that rates are coming down. We keep getting lower highs in yields here, like the last peak.
Where are we now? We're at 420 on the 10-year. I mean, that's
yeah, we're at 426 right here.
426, right?
Okay, so we had this failure from 460. This is when people are saying the Fed might even consider a hike, and then they said no hike. Yep. Does the Fed lead the market or follow it?
Well, I think the story of the last, well, when did the Fed last raise rates? It was July last year, wasn't it? So it's almost a year since the Fed raised rates, and that's when it kind of stopped. So we're almost a year into that, and where have we gone in market pricing since then? I mean, I seem to recall at the start of the year, January 1st this year, the market was pricing in what, 6 cuts?
Yeah, it was crazy, yeah.
6 cuts, and now we're down to, well, 2, and the Fed is indicating 1. And as you just said, only a few weeks ago, we're talking about none, possibly a rate hike. So I think the Fed is leading the market. I think that's fairly clear.
Okay.
But the interesting thing for me is that
But they
market,
didn't they lead the market to go ahead and look for 6 cuts?
well, maybe not 6, but you're right. They did have that
So
dovish pivot, didn't they? And
yeah,
that seemed to
yeah.
be
So
short-lived.
that they misled the market. They didn't lead the market.
Misleading, yeah, perhaps.
Okay.
Perhaps that's more accurate. I mean, but when was that? That was in the early part of the year. Maybe they were too gung-ho, a bit too hasty to put too much faith in 1 or 2 inflation prints. They turned out to be not quite an accurate read. It's all ifs and buts, and the proof of the pudding is always and only in the eating. And we will see if we do get more of these soft inflation prints. The PPI number last week was also quite soft. So if the pipeline pressures for prices is toward continued disinflation, then I suppose it's fair to say that the Fed might have to sort of backtrack again and go for the 2 cuts. However, we had the Minneapolis Fed President, Neil Kashkari, just on the wires. He was on TV yesterday saying that one cut towards the end of the year seems realistic. Does he speak for the majority? The median would suggest he probably does. However, Powell, as we know, is he's more dovish, and he probably carries sway, but he's not really speaking for the median right now, probably.
Is he a voting member, Jamie?
Kashkari? Oh, that's
yes.
a good question. I don't know, to be honest. He may
Yeah,
not
I don't
be,
think
but...
he is.
Right, okay.
Okay, I
so
think
he's got maybe more, he can speak more freely, perhaps.
Yeah, he's a mouthpiece. He's probably
It's quite a
sent
vocal
out
one.
there, huh? Have you ever been, I'm Face's mouthpiece. It's not a bad thing to be. You're Reuters' mouthpiece. Anyway,
no, I would never claim that. But well, listen.
All right,
but one cut. I mean, but to be fair to him, one cut this year is now the median projection. So he is kind of in a way speaking for the majority. But I mean, at the end of the day, does 1 cut this year or 2 cuts when they come? Is that really? I mean, is it
meaningful?
I know we talk about this. Yeah.
Yeah. You got me.
I suppose it's to me it's whether it signals the start of a cycle, and how long is that cycle going to be? How deep is the easing cycle going to be? I think that's much more important for markets, rather than if it's when does the first cut come?
Well, as a technician, and just looking at the move we had from 5 to 380 here, if we have the same type of thing from here, it gives you 350, takes out these lows. So
that's quite a long way down. That looks quite a long way down.
Could Europe be the problem that sends rates down? Are you paying attention to what happened in Europe and some political instability? And
absolutely, yeah.
Okay, is that the big story going forward the rest of the summer until the U.S. elections? Whether the snap elections in France, and that if there's still demand for bonds, French bonds, which, unlike us, they don't have a bank to come in and buy them and support them.
Well, they do, don't they? They have the ECB.
Okay, they have
ultimately,
but they don't have a plan, do they? They don't have a plan in to go ahead and do it. Was the ECB buying the gilts when the gilts had a crisis, or that was the BOE?
That would be the Bank of England, yeah.
Okay, so the ECB didn't help them out. So why is the ECB going to help France out if they have trouble?
Because France is not only in the Eurozone, it's core Europe, core Euro.
Yeah, true.
Obviously, we're kind of back in, or we could be back in 2012, 2010, 11, 12 territory. I think you mentioned earlier the spreads, French spreads with Germany are now up to 75, nearly 80 basis points. That's the highest since 2012, I think. And of course, it was in 2012, July the 26th, that year, that Mario Draghi came out and said that the ECB would do whatever it takes. And I mean, you have to look at what's happened since, and to think that the ECB would. Well, when he said that, everything changed. I mean, it might be a bit cliched, it might be a bit simplistic, but everything changed when he basically said that the ECB would be the backstop for any Eurozone.
So they could do that again.
Absolutely. I'm not sure of the mechanics of it, what programs they would use, whether it would be existing programs or combination of existing programs, whether they would have to tweak them or come up with new ones. But if the ECB was going to backstop the periphery, Spain, Italy, Portugal, Greece, etc., it will certainly have no hesitations in coming in to backstop France. Because if France goes, then the whole Eurozone project goes, and I don't think that's in anyone's thinking in Frankfurt or any of the capitals of the Eurozone. So it might take some sort of inventive financial engineering and whatever it takes, but they will backstop France. I've got no doubt about that. It could get messy in the interim, and we could see spreads blow out further. We've had the ratings agencies come out warning about downgrades. That has spillover effects on the banking system, etc., and borrowing costs. But I don't think the ECB would stand by and let France go under. No.
So let's go into the banking system, Jamie. The statement from Jerome Powell is banks are strong. They've repaired their balance sheet. They're financially in a good position. They got rid of the emergency facility from SVB. And then, those are words.
I think some banks are still taking up some of those. There was a couple of emergency lending facilities introduced in March last year, and I think there are a handful of banks that are still tapping that, if I'm not mistaken, but it's very small amounts, isn't it?
Okay. And I thought they ended it, and my question is, do banks really look strong? And even the money center banks, Jamie, with the huge moves that we've been having in equities in general, not in general, specifically narrow advance with tech leading, the banks aren't making new highs here. And that's even this negative price action so far. I'd love to see one more high, but especially in KRE, this negative action has happened with yields falling.
Is that the banking index that you're showing me? Yeah, the KRE.
This one?
Yeah, the banking, yeah.
Yeah, this is regionals.
The regional banks, of course.
Yeah, and this is why the Russell can't get off the ground. So, the charts are saying the regionals aren't out of the woods.
Look at that. I think I'm no technician or chartist, but it looks like we're coming up to support there.
Very important support.
Yeah, looks like quite big. Going back.
But when you look at it through a telescope here, Jamie, and you could use this on Reuters, it's fine with me. But this was a crisis, right?
Mm-hmm.
And this has been the recovery since the crisis in March.
Right. So it's not been. Okay. So we have recovered, but by no means we haven't.
Yeah,
like half the.
Not even. Just got back to where it broke down from and starting to roll over again. I still think there's going to be some headlines about banks coming up, especially later in the year.
If you're right, and you may well be right. If there are more problems with the regional banks, I think the Fed was pretty quick to act in March last year.
Yeah, they were.
It was very quick to act. If I recall, it was March 16, 17 over a weekend. Boom, they came in with programs and facilities, and I think they would, we're talking about ECB backstopping France. I think the Fed would come in very quickly and offer whatever kind of lending facilities, discount windows, or special rates, whatever it takes to backstop the banking system.
Okay.
We may get interim, we may get more weakness, but I suppose it's like anything, until it becomes a problem. And you said Powell himself doesn't see any problems. The Fed doesn't see any major cracks appearing. That's not to say they won't, but right now, in the here and now, on June the 17th, they don't see anything cracking right now.
Well,
but if
Bernanke
they did,
said things were contained too, right?
But he was saying, was he not saying that after things had started to crack? Time.
So in your mind, things haven't started to crack.
Well, I don't see it just yet. I mean, maybe if as you say, those support lines break and shares really start to take a bath, then I think that would get everyone's shackles up.
Okay, and your view on the upcoming elections in the U.S., does it matter in financial markets or tax policy, which one is elected if they could pull off an election?
I think I don't think we're seeing any election pricing play into financial markets now. As I say, June,
Right.
we're 5 months away, just under 5 months away. I don't see any election pricing. You've mentioned stocks are at all-time highs.
You're right.
Yields are coming down. Volatility is at historic lows. Credit spreads, high yield spreads are super tight still. Now, you can argue whether that's right or wrong, but right now, I just don't see any election risk of pricing being put into those prices just yet. I think that will change. Obviously, the closer we get to it, I think that may change. But right now, I don't see any election risk. Do you?
Well, the market's probably with the VIX, like you mentioned, where it's at, there's no risk. It's complete complacency, and that's what makes me nervous.
Well, maybe the VIX is not the best indicator because it's a 30-day.
All right, credit spreads.
Credit spreads, yeah. High yield spreads are super tight.
Yeah, so there's a lot of complacency. Everyone thinks it's going to be all right. Even you, which I give you a lot of credibility, Jamie. You know, every problem I bring up, the Fed could fix. So why worry? Be happy.
Since 2008 and since COVID, has there been a problem that the Fed hasn't fixed, at least on the face of it or temporarily?
No. So recency bias backs it up, that the Fed is there as a backstop. So there is a Fed put. For a while, people were saying there was no Fed put.
No, I think there is. If we talk about the Fed put in those terms, in the broadest terms, but of course that's part of the Fed's mandate. You know, it has to ensure financial stability, stability of the financial system, and it's not going to let the regional banking system collapse, or it's not going to let the treasury market collapse. It's not going to let it's not in the business of setting asset prices or values, but it's certainly in the business of making sure the whole system doesn't go under. So yeah.
Okay.
All right. I think the Fed put is there, and in terms of the Fed balance sheet, it was interesting. I was at the iConnections conference in Miami in January, the big sort of hedge fund and alts investment conference in January, and there was a panel. I can't remember who was it. I think it was Zervos and Mike Wilson at Morgan Stanley. They were on a panel, and they basically agreed, and I tend to agree with them, that the Fed will maintain a super huge, super large balance sheet as far as the eye can see. We're talking like 5, 6, 7 trillion balance sheet. So the Fed will do QT and it will reduce the balance sheet, but it's not going to get it back down to anything like what it was pre-2008.
Okay, and they did reduce QT on treasuries, but not on mortgage-backed securities. Why? Are they worried about what the paper is backed by on the mortgage-backed security side?
Well,
or
possibly,
trying to support the bond market?
Well, I think, where are we on 30-year mortgages? I haven't looked for a while, but we are, what, 6 or 7%?
Yeah.
That's pretty high, especially if you're coming off, if you locked in down at 2 or 3%, and that's rolling off and you're going up to 7%.
Yeah.
So maybe that was part of the thinking.
Okay. All
so
right.
Yeah, but just to, as always, there's always another hand. While the Fed might maintain a huge balance sheet, and I think it will, of $6-7 trillion dollars as a percentage of GDP and as a share of the market, that's actually going down.
Okay. So I'm showing Jamie's feed. You have to follow Jamie at Reuters, Jamie, so you could keep in touch with what he's seen in the market. Do you think that the move to the right in Europe is mainly driven by migration issues and border issues. Do you think that's a foreshadowing of what's going on in the U.S. and all over the world, that we're moving, the pendulum has swung from left to right in a pretty serious way?
Oh, you can argue. I mean, there's a thousand arguments for why the right there has been or there is a rise of the right of the far right in Europe or in the States. Probably don't have time to get into it all here, but I think it's undeniable that it is real and it's happening, and we'll see in France whether that goes further and Le Pen actually gets in, and the Front National or the far right gets in France. I suppose what we here to talk about is, does that have any impact on market pricing? And I think, as I said earlier, the credit ratings agencies are warning of the rise of the right in Europe and some of the policies that may have economic policies, whether it forces France towards the Eurozone exit or puts pressure there. Here in the US, it's obviously we don't have the Eurozone, but I think Trump has, I think there are some concerns about maybe the independence of the Fed. There's obviously tariff policies and trade wars. So these do have real consequences. And as you said earlier, maybe markets are slightly complacent right now, but there will come a time soon enough, perhaps, when they can't be complacent and they will have to react accordingly.
Well, here's John. My sister is John Q. Public for me, and I brought this up to other guys. And she said, Dale, I'm going to get out of the market in October and get back in after the election. So a lot of people are thinking everything's okay until the fall. So
that seem fair enough.
Wouldn't that be a surprise? It really shouldn't be that convenient that that someone who's not an expert is going to have a perfect timing strategy for when to leave the market to avoid the downside and re-enter at after the downside has completed. I give that a 1 in a million shot. How about you?
If it was so simplistic,
everyone
would be doing it, and we'd all be sitting on some.
Well, I think a lot. Is there anything that could throw? What would be the one thing of everything that you watch that could throw a monkey wrench into everything being okay until the U.S. elections?
Oh, good question. Obviously, we've got the French elections. I think we can maybe discount the UK election. I think that's basically a foregone conclusion. And to be honest, there's not much of a difference in terms of certainly economic policy, even tax policy. There's not much of a difference between the two main parties there. So we can kind of maybe park that to one side. In terms of global impact, the French election could be significant, most certainly, and we could get a lot of volatility. And that would spill over, obviously, into Eurozone assets, and it would certainly push down or push up spreads in Europe, force maybe money into the dollar, into treasuries, even more money into the dollar and into treasuries, so you could get some outside market reaction there.
What's a BOE going to do this week, Jamie?
Nothing.
Like usual. Right? All right.
So far.
All right. What's the BOJ going to do? Like nothing. They did last week. They did nothing. Do you think there's something could come out of the BOJ? Like
the Bank of Japan's an interesting. I think, but they're. I mean, I was kind of thinking, and I kind of wrote last week, or I kind of threw it out there. If the Bank of Japan wants to continue normalizing policy, if it wants to start tapering bond purchases, etc., raise rates even, raise rates again, what are the ideal set of global conditions that it would seek to do that in? You would have to think a fairly stable Fed, fairly steady, relaxed Fed, possibly tilting towards easing. Okay, the dollar's rising, but it's hardly going gangbusters. Volatility, as we just discussed, across the board, across assets, is ultra low. macro volatility is low, credit spreads are tight, Japanese stocks are doing well. Is that not the kind of conditions in which to start or to continue normalizing policy? You would think so. So if they've not done it now, it begs the question, you know, what are they waiting for? I'm not quite sure what the answer is there. Maybe domestic conditions, they're afraid of raising rates because of the impact on consumers. I get all that. But if it's been well flagged enough, and as I say, the overall macro environment could not be more benign or conducive to continued or accelerated normalization. So I'm not quite sure what they're waiting for. We'll find out maybe next month. But by next month, you know, France could be, you know, all over the place, and we could get much more volatility. Could be much higher, general market volatility, and I don't think they'll be inclined to move in those kind of circumstances.
Well, I've heard from many guys that predict things that they felt that this next crisis, unlike 08, would begin in Europe, then spread to Asia, and then wash upon the shores of the U.S. That we're not going to be ground zero for the start of this. So we'll be the cleanest dirty shirt until the washing machine fills up on our shores. So
and what does that mean? Stronger dollar, lower yields. Everyone's buying treasuries. Everyone's buying the dollar. Wall Street probably outperforms. U.S. stocks outperform.
Can you give me a reason to be bearish the dollar, Jamie? Because technically I'm still trying to top pick it. Can you justify it in any way? What would make the dollar go lower? Because lower yields didn't help last week.
No, that's an interesting one on yields, and as you know, we all know, but it sometimes does bear repeating. You know, foreign exchange is a relative game, so there might be several reasons to be bearish the US or bearish the dollar, and you think the yields are going down, could go down to 3.5%, as you say. Doesn't mean to say the dollar will go down because of what's happening elsewhere. And I think we're kind of maybe seeing that now, certainly with, as we've discussed, with France and Europe, and the BOJ sitting on its hands, dollar yen still near intervention territory. So, I mean, you know, the uptrend in the dollar index seems to be fairly well established.
So it's a contrarian. It's a contrarian trade then to be bearish a dollar, because most, I mean, you know, you at Reuters, I'm sure you have currency analysts, and you read other. Most people are constructive on the dollar, aren't they?
I think so. Yeah, I think for those kind of reasons, and as you said, you know, well, we've got the huge bursts on Wall Street as well. Continues money, I suppose, is still flowing in from overseas into US equities and US assets. The contrarian trade would probably be to be short the dollar. We've seen the hedge funds, as per the CFTC data, they were reducing their dollar long positions for about 6 or 7 weeks, but that's, I think the numbers from Friday showed that that's now snapped back higher again, and so they've started to rebuild their longs again. But I mean, positions have been kind of squared a little bit, or certainly lightened. So maybe funds are going to go back long again. It's hard to say on the face of it. Or there's no obvious reason to go heavily short dollars here, other than maybe positioning or consensus view is overwhelmingly long.
All right, let me wrap it with the most important question of the whole interview, Jamie. Has NVIDIA topped? Has it topped, Jamie? Come on. What do you think?
It's topped for today.
Yeah.
It may well top again tomorrow and the next day.
Yeah, pull back.
I mean, we've seen, I think, I don't know how closely you follow these equity calls, but Goldman have raised their S&P 500 target for the year. Obviously, a lot of it's based on the AI boom.
Okay. So
they're
what?
saying maybe up to, what did they say? Hold on a second. 6,000? 6,000 is possible. I think 5,600 was their target, with 6,000 possible. But Evercore, they officially raised their target to 6,000 for the end of the year, and said that by the end of next year, get this, 7,000 is possible. Wow. So when you start to get forecasts like that, do you say to yourself, hold on a second, are things maybe getting a bit out of hand, a bit too bullish? And as we all know, it's kind of the rally's been based on literally a handful of stocks. So I suppose the Fed would be more than an interested observer. I mean, because if Nvidia and the Mag 7 take a bath, if they take 10-15% on the downside, that has a big impact on the overall market, which has a big impact on the wealth effect, consumer sentiment, etc.
So what does the Fed want? We'll wrap it with that. Does the Fed want to stop this runaway bull market in stocks? I mean, there used to be a narrative out there that the Fed, to slow down inflation, wanted a negative wealth effect to take hold. They haven't acted that way. Do you think that they want this bull market to continue, or they prefer to have some negative wealth effect to slow things down for the upper 1%, 10%?
Well, as we mentioned earlier, the Fed is not in the business of, well, I don't think it is, certainly not officially, and even I think even unofficially, it's not in the business of setting market values or rates or levels, or it's not in that business. If you just take a step back, unemployment is 4%. GDP growth is still above 2%, probably on average annual rate. So that's probably above potential slightly, perhaps. And financial conditions, and inflation is heading 2.5%, 2.6%, 2.7%, depending on your cut, heading back towards that 2% level, slightly above. I think if you'd asked anybody at the Fed a year ago, 18 months ago, fast forward to now, and you've got that set of macro conditions, would you take it? They'd say absolutely. And if you said, do you think the S&P would be where it is now? Do you think Wall Street would be where it is now? They would probably say no. I think most people would say no. You'd probably, with rates being on hold, you'd probably expect equity prices to be lower. So it is a Goldilocks or soft landing. It's a benign set of conditions overall. The difficulty for the Fed is the higher stocks go, the effect on financial conditions is that conditions are loose. They're getting looser. Yields are coming down. So that's a concern. It's just going to sort of accelerate this sort of spiral of rising asset prices, looser financial conditions that could spill through to inflation. That's a concern, certainly.
Because he said that policy is still restrictive. And you're saying financial conditions are easy. Okay, that's what I mean. Which is it? He's saying that
the two can
coexist.
They can coexist. Yeah, it depends on how restrictive you think policy is, and then that's when you get into the nebulous debate about R-star, etc. There may be, in some estimates, you could say policy could be restrictive by 200, 250 basis points, 300 basis points. So if by that measure, financial conditions can loosen and continue to loosen, yet still be in kind of vague, restrictive territory. It's all a bit vague, it's a bit nebulous, and maybe people shouldn't put too much faith and store into those kind of theoretical debates about R-star. But what the Fed has done is stay on hold, and it's not cut rates, it's not cut policy rates. So you could argue that maybe policy is more restrictive than it would otherwise have been had markets had their way at the start of the year.
Will Belgium win today?
Who are they playing?
I don't know, but the guys in the room were talking about it. So I don't know. Well, anyone here?
I don't know. It's 3 minutes. Who are they playing?
I'm not sure, Jamie. Anyway, people follow Jamie at Reuters. Jamie, go check out his columns on Reuters so you can hear and read what he's thinking more than once every quarter to stay on top of things. Jamie's a great source and a great follow and a great guest to interview. Thank you so much, Jamie.
Thank you, Dale. Pleasure as always.
Enjoyed batting the ball around with you, buddy.
You too.
All right.
Speak soon.
Jamie McGeever, everybody. That's going to be a wrap for us today. You could join the team in 10 minutes on the Morning Edge. And we'll see everyone tomorrow for Turnaround Tuesday. Good hunting. And don't just count your pips, count your blessings. Thanks again, buddy.